So this stock, Academy Sports and Outdoors, ended yesterday's trading day up a whopping 16% in a single freaking day. And that was because of its earnings. Apparently the company's Q3 earnings were pretty darn solid. And since I've talked about this company a bit on this channel, I've decided to update you all on my updated thoughts on the company. Let's get into it. Q3 earnings. And honestly, I don't really understand why these earnings caused such a big reaction on the stock market. Maybe the stock market was looking at this company as if they would completely flop their Q3 and Q4 earnings of this year. And maybe these earnings sucked significantly less, hence why there was such a big overreaction to the upside. Well, most likely we'll never really know. So let's just look at the earnings as they are. And then we can see if the story I sketched out during my last video on Academy Sports and Outdoors needs to be changed. And if we look at those earnings, we can see that the company did pretty darn well. Sure, if we compare their numbers to 2021, they are down on almost all metrics. But 2021 was a really funky year. The United States was coming out of a pandemic and there was a lot of pent-up demand for sports and outdoors gears, hence why Academy flourished. Now, if we just see a small slump compared to 2021, I already believe that's a massive achievement. What I do dislike, however, is this drop in net income margins. You see, the company was only able to maintain 8.8% of their revenues as net profits. While during the first and second quarter of this year, the company managed net income margins in excess of 10%. So there is a significant decline here. And I will have to monitor this decline, because we do not want to see these net income margins decline all the way down into the negative territory. But for now, not a big deal. This is just something we have to monitor once we get those fourth quarter earnings. Next up, the balance sheet. The company does have slightly less cash than I would like them to have, but this amount is nowhere close to being worrisome. Their inventories have increased year over year, which is again something we'll have to monitor going to that fourth quarter. We do not want to see inventories increase into unmanageable territory. That would mean that the company is unable to sell their wares. But slight increases are of course never a problem. The company still has a very solid current asset position compared to their current liabilities position, so I personally do not worry about their liquidity at all. And the rest of the balance sheet has basically remained the same quarter over quarter. Nothing jumps out, which is a good thing. And the last thing we should keep track of is their full year 2022 guidance. You see, the company is basically guiding for the same thing. The profitability of their high-end guidance is remaining basically the same, but the profitability in their low-end guidance has increased significantly. Also good to note, the company has apparently bought back an additional 1 million shares of the shares outstanding, so now there's 1 million shares less to worry about. Aside from that, the story on the guidance front has remained basically the same. That means that the story has remained the same on all fronts. Earnings were really solid, except that we do have to monitor that decrease in net income margins. 2, the balance sheet was also really solid, except that we do have to monitor that cash position and that inventories position. And lastly, their guidance has become slightly better than it previously was, which was already pretty freaking phenomenal. And that finally brings me to this, my previous price predictions and buy targets. And because the story has remained largely the same, we only gotta change one figure, which is this number, their 2022 earnings per share. They are guiding for a slightly higher figure, so we have to adapt this number up slightly. Now the rest of the story remains largely the same. I believe these growth rates we sketched out here still gotta remain the same. I see no reason why the company wouldn't be able to hit these growth figures. Now I still believe a future P ratio of 15 is fair, and I still believe that this discount rate of 15% is conservative. But, and this is important, the intrinsic value of ASO has increased from $80 to roughly $85 per share. So the upside I see on ASO compared to the current share price has increased slightly. Now I do believe we can expect an additional 50% upside on the short term. But of course, macro factors still apply. Now, would I personally buy ASO at the current levels? Most likely not. Not in any big quantities anyway. Based on this prediction, I would personally start buying below the $50 mark. And personally, I would start really buying heavily once it approaches that $45 to $40 range. And from a more macro view, I do believe we've hit the top of a bear market rally on the broader market. By the way, this belief is based on some very rudimentary technical analysis. So I personally don't put too much value and weight on that technical analysis. But it can mean that we'll see ASO at more attractive prices reasonably soon. And until we see those more attractive prices, I will just continue to hold my shares. I did buy those shares in the $40 to $45 range, by the way. And if we do hit $70 or more on the short term, I will not hesitate to sell. And until either of these situations happen, I'll be waiting to either buy more for lower prices or sell for significantly higher prices. But then again, while I am a registered financial advisor in the Netherlands, this video should not be taken as financial advice. These are just my opinions, which can never be adapted to your personal circumstances in these types of videos. Now, with that said, thank you so much for watching. I love you all. Peace.